Good afternoon, ladies and gentlemen. Thank you for coming to the third iteration of the speaker series on risk management and insurance. We are delighted to have you. We have a great speaker today. And one thing before I start, I would like you to mute yourself and so that there wouldn't be any noise and disruptions as we move through the process. One of the students asked me that when the students are participating, would they be recognized in their transcript for participating in this program? And as I mentioned earlier, which is actually in the syllabus of this course, if you participate in 4 out of 6 programs, then it will be registered in your transcript. So it will say that you have taken this course. We are monitoring that list. And as we go to the end of the fall program of the speaker series, then we notify the students, and I notify the undergraduate and graduate office in terms of moving this to the next step. So I'm delighted to have our speaker today, and a good friend of mine, Jeff Rosenberg. Jeff, I will talk a little bit about his background, but he is presently an adjunct professor in our Master of Science in Finance program. He has been teaching a course which is called Valuation, which is a very important course, and it will tell us about basically how projects are evaluated, what techniques and strategies we need to use in order to basically come up with the value of the project and decide whether the firm should take it or not. Beyond being an adjunct professor, Jeff has been an analyst and a sell-side analyst at William Blair and Company for over 14 years. He has expertise in the technology and the semiconductor basically industries. And as I mentioned, he has been with us since 2018. And I'm going to stop at this point and leave it to Jeff to move this process forward. So welcome to From Bubbles to Bursts to Busts, real-world lessons about the stock prices and valuation. Jeff, take it away.
Thanks very much, and really appreciate the invitation to give this talk. As you guys will see momentarily, it was a chance for me to really take some stock in my entire career, and you'll hear a little bit about how I've been the beneficiary of both bubbles and busts, and I'm hoping right now just kind of a quick check, everybody can see my screen, and right now you should see the title screen. So let me know if you don't, but otherwise I'll go ahead and get started and move on to the first actual slide of the presentation. So this quote is here as a reminder that while booms and busts may sound like dramatic outlier type events in the market, in fact, we see them a lot. They're not uncommon at all. And it's meant to demonstrate that market extremes are actually a very interesting way to examine valuation. And they go a long way to illuminating, some of the important points that I'd want to leave you with about how valuation is, how we think about it academically, and then how we really see it in the real world. And again, you can see that in both booms and busts, but they're also an interesting way, as I just alluded to, for me to recount my career, which has been most closely tied to 2 of the biggest bubbles and busts that we've seen in the past 30 years. So the first one that I want to talk about is the internet bubble of 2000, which was frankly very good to me. I was a new analyst picking tech stocks in the late 90s, and for anybody that needs a little bit of just who doesn't immediately sort of get the idea there, that was pretty good work if you could get it. And so, I was fortunate in that sense. And I would tell you that, in the course of this talk, if I'm going to leave you with any career advice, I think the best thing I can tell you is it's a good idea to have good timing. And here's an example, tied to the internet bubble. So if I take you back to the beginning of my time in the investment industry, I started on the sell side of the industry, which means I was doing equity research at a brokerage firm. The name of the firm, brokerage firm / investment bank. And the name of that company is William Blair and Company. And in that role, I didn't do any investing. Even though I was in the equity research department, I was not investing. So what happens when you're a sell side analyst, just for anybody that needs a definition, you're given a sector and you choose companies to cover within that sector. And then you're covering those companies by writing research for institutional clients and for the in-house brokers that we had and for the portfolio managers who hopefully would read that research and use those ideas in their work so that your recommendations would lead to investing through your clients and through in-house people that were working with clients. So I joined Blair in the mid 1990s, and we were a very well-respected firm, known for doing in-depth quality research, but I would also say a relatively conservative firm. And so we didn't have too many technology analysts at the time that I was getting started. We had 2, to be exact. And to kind of compare that, we had 4 retail analysts at least. That might have even been more, but we had a number of retail analysts, and we even still had we were a growth-oriented firm, but we still had a food analyst in the firm. And so if you go back 30 years, food was still a growth industry. Hershey's, Campbell Soup was a stock that tripled between 1994 and 1997. So you could still do well there as a growth investor. And as an investment banking shop, you go back to, I think it was about 20 years ago when Smucker's bought Jif. Blair was one of the investment bankers working on that deal. And so, putting peanut butter and jelly together, that was the kind of stuff that Blair did. But by the late 90s, clearly the world was increasingly focused on technology, and our competitors in the growth-oriented segment of the market, I all had at least 10 tech analysts, and we again had 2, and they both covered software. So no one covered computers, no one covered networking equipment, no one covered semiconductors. All those areas were wide open. And so in the summer of 1996, I had the chance to become the 3rd tech analyst. And just to give you some idea of where we're sitting in the timeline of life there, that's about 2 months after Yahoo had their IPO. So things are really, starting to kind of come, pick up momentum in tech and in the internet. And I start doing work and looking for ideas. And so my first stock recommendation was in February of 1997. I recommended that clients buy a company called Selectron. And that's probably not a company that many, if any of you have ever heard of, because as we'll talk about in a minute, they're no longer out there in the public markets. But even at the time, I don't think that many people had heard of them because they were a contract manufacturer. So their biggest customers were Cisco Systems, Hewlett Packard, and IBM. People had heard of those companies, obviously. But what it was going on was those companies were going through a change in their business models where they were no longer manufacturing their own equipment. So Cisco Systems at the time would talk about they were in a very high growth mode, and they would talk about how they might not have been able to achieve that growth if they had to build up all the manufacturing infrastructure themselves. So they outsourced it. The big established companies like Hewlett Packard and IBM, they all realized that they weren't really differentiating themselves based upon being able to manufacture better. It was the quality of their systems that really defined their success. And so they decided to outsource the manufacturing. And so that was a growing industry, and Selectron was one of the best and one of the biggest companies doing that. So as you can see, I think you can see my cursor here. I mean, I'm picking up the company somewhere in this time frame in early 1997. The stock had already been doing quite well. But that said, the internet boom was, as I said, was picking up steam, and the conventional wisdom was that people would use the gold rush analogy. So if you think about the idea being, if you're somewhere and there's gold up in the hills, well, one of the ways that you could take advantage of that would be to go out there, stake a claim, go out and pan for gold, and hopefully be somebody who discovered gold. But that might not be the best way to really benefit from a gold rush. What some people believe is the best thing to do was to be the one selling the picks and the shovels that are being used in the gold mining enterprise. And so, with that analogy, my assignment was to figure out who was making the picks and shovels, and clearly, Selectron and more directly, Selectron's clients were the ones doing that. And so, looking for the guys that were building the semiconductor chips, the routers and the servers, those were the companies that were building the internet. And so picking up Selectron was just the beginning. And as I said a minute ago, picking tech stocks in the late 90s was shooting fish in a barrel. It was pretty straightforward to be successful when you were fishing in the right pond there. And there were a lot of good choices to be made, and they made me look pretty smart. And by the end of 2000, before the music stopped, so to speak, I had a lot of success at William Blair, and they made me a partner, and so I was in the right place at the right time. So the question is, and relative to this talk, is in the middle of all this, did I realize during my exciting ride in 1998, 1999, and into 2000 that we were in a bubble? And to be honest, I can't say that I did. I'd never really lived through a true bubble before. And what the key thing that I didn't fully appreciate was that the root of every investment bubble is truth. So when you're thinking about a bubble, you don't want to think of SBF and the FTX cryptocurrency exchange or Enron, where there's fraud and it's all a big lie. That's not the lesson here, and that's not what a bubble is. Just because business for Selectron and the other companies that I was doing work on at the time and recommending was great, and the underlying growth driver, that the building of this information superhighway, was real. I mean, obviously, as we sit here 20 plus years later, we know that was a very powerful growth trend. And so I didn't realize that could still mean that it could be a bubble. And the key was, I didn't appreciate back then that bubbles are almost always based on something real. It can be, for example, it's not always technology. It can be a great new business model, a great new business opportunity. For example, in the 1960s, there was a boom in companies whose growth was being driven by M&A. This idea that you could do a lot of M&A, and as long as you weren't buying up all your competitors and cornering the market in whatever your business was, which would obviously draw the attention of antitrust regulators, you could build a conglomerate company. Even if your core business was not growing very much, you could grow by acquiring other companies. You would use your stock, get other companies to take your stock in an acquisition, and then you would come in and you would take advantage of all the opportunities to cut costs. You didn't need two CFOs. You didn't need two audits. You didn't need a lot of things. And you would start to cut back on those things, and then you'd attach a fancy name to it. You'd call it synergy, where 1 + 1 = 3. And you demonstrated that you could be doing this for a long time to come and build a conglomerate business. And there were a lot of businesses that started to do this and experienced a lot of success, and investors got excited about what they were doing. And so more and more people poured into this model, and more people started to buy these companies, and that became a business model driven investment bubble. Now, in that case, some people took the idea too far. The SEC started to find a few people that were maybe being too aggressive with their accounting, and at some point, after a number of years, it all kind of imploded. So it was a bubble that also that burst and turned into a bust. But that's not something that it kind of is an example meant to demonstrate it's not always about technology, but more often than not, it is about technology. And so, and the internet was not the first time that happened. I mean, so just the idea being that these bubbles occurred with regularity. And if you go back to the late 1950s, there was a gentleman named Jack Kilby at a company called Texas Instruments who invented the integrated circuit. So the invention was the idea of putting multiple devices on a piece of silicon, and that changed the way that electronic products were built, and it built the semiconductor industry, which has changed the world arguably even more than the internet changed the world. So it was another example of a very exciting technology at the time. Texas Instruments as an example, has become is a $140 billion company today. So the true innovators in the market, even if there was a bubble that built up and a bust that came thereafter, you go out way into the future, they remained very good investments. But a lot of companies along the way, at the time that there was all this excitement at the beginning of the electronic age, they were able to sort of just take advantage of the sentiment and the excitement around it. So, for example, in that time frame, there was a little company called the American Music Guild that sold. What their business was is they would sell records that today the type that were played on turntables at that time, and they would sell them door to door. But they changed their business a little bit, were able to convince people that there was some electronic element about how they would grow. And they took their company at $2 and it soon went up to $14. So these bubbles have occurred repeatedly through time, and they are based on big deal inventions, the microchip, the internet. I mean, these are things that did in fact really change the world, but they still can create excesses. And that's the part, the idea that even real growth can turn into speculation and wild excesses that I'm trying to get across. And, we may be seeing it as we speak with that when you think about generative AI, because that is an example of a technology that is very real and it's going to be very important. But you have to ask yourself whether or not the excitement around it is perhaps creating some excesses. But let's go back to me in 1999. And again, this question of, did I believe we were in a bubble? Because people did start to talk about it as such. And my first take was that they were kind of being alarmist because, again, the growth trend that I was observing was real and I believed it could last for a long time. But eventually, as the stock kept rising, as you can see in this example here, as it's going, kind of going on for quite some time, and the stock is going up a great deal, I did make the decision that bubble or no bubble, things had gone too far, and I made the decision to downgrade the stock. So what does that mean? It means I announced one day that I was no longer recommending it as a buy and implicitly no longer recommending that clients own the stock. So what did my boss do after I'd made this call? Did he congratulate me for being level-headed amidst all the hysteria and keeping my eye on what's important and keeping a focus on valuation? Or did he, congratulate me for having the courage to make that call, because people that owned the stock, they were clearly making a lot of money and they weren't going to be happy with me for doing it? Well, the answer is not really. I distinctly remember when I saw him in the office, probably that day, certainly shortly thereafter, and his feedback was, you should never downgrade a stock strictly on valuation. And I remember being very surprised, but sure enough, I can promise you, I did not do it at the very peak of the valuation. I did it somewhere along the way, and Selectron would continue to climb for quite a while. And so the truth is that eventually things, as you can see, I don't have to tell you, things eventually didn't end well for Selectron or any of those high-flying tech stocks, and it did prove to be a bubble, and it burst. And in Selectron's case, the stock would go down 90% from its peak, well below the price where I downgraded it, and the company, which at one point was worth more than $28 billion, was bought by a competitor for $3.6 billion towards the end of this chart in around 2007. So let's go back to that question of, did I make the right call in downgrading the stock? And one of the first lessons I'll give you from a real world perspective comes back to this issue of timing. And in that sense, maybe my boss was right, because even though I was right in the end, as I say here, there's at some point, there's not much of a difference between being early and being wrong. And so that's an element of kind of how you got to think about these things and really pay close attention to timing. But let's move on to talking about busts. So the bust I want to talk about is one of the biggest stock market collapses in history, the great financial crisis of 2008. And we want to examine the question that if stocks can reach excessive irrational highs, is the opposite true? And as it related to me and the time frame in 2008, once again, my timing was actually good. So believe it or not, the great financial crisis was also good to me. So let me explain how that could be true. So if we fast forward, and I'm ready to make the next major transition in my career. I've decided after 14 years in my sell side job at William Blair, I was going to make the move because I wanted to move to the buy side. So as I told you before, I wasn't doing any investing in my sell side role, and I wanted to do the investing. And to do that, you move from the sell side to the buy side. And Rail Splitter Capital is a small buy side firm that had actually been founded 6 years earlier at the end of 2002 by one of my colleagues, someone I met when I was at William Blair. And so the William Blair heritage means a number of things. But one of the things it means is that even though they've been around for 6 years, they still didn't have a tech analyst either. They needed a tech analyst. And so in the summer of 2008, I had been talking to them for a number of months. It had clearly been a tough year in the market. You can see that here in this chart of the S&P 500. And the market was probably down about 10% at that point. But they did need somebody to cover tech. And so in July, they decided to hire me. So I'd been at William Blair, like I said, for quite a while. I had a supervisory role at that point. And so William Blair asked if I could stick around for a while. So I didn't give them 2 weeks notice. I gave them 2 months notice. And what that meant was, we go, that's going to take me through August and September. And in September, that's when Lehman collapsed. One of the most stressful periods that anyone can remember in the market. And I'm a lame duck analyst at Blair, not doing a whole lot, to be honest. And that week, I was actually away with my wife on vacation in Napa when Lehman actually went under. And so I'm sort of just out there observing things from afar. I did worry so the only stress I had is I thought the phone was going to ring with Rail Splitter saying, tonight, this might not be the best time for us to be expanding, but the market, as you can see if you look closely, it was kind of holding up okay. It wasn't collapsing right away. And so nothing much changed. And on October 1st, I started my new job. And in October, the market dropped 11%. By the end of November, it had dropped double-digit percentages again, and it was down 23% after my first 2 months on the job. And by the end of the year, for the whole of 2008, the market was down 38%. And what's going on with me? I own almost nothing. I'm just getting started and looking for new ideas. And so the question is, did we get to a point where there were excesses on the downside that gave me a great opportunity? And so as an example, there was a stock that I was looking at that had come down 40%. And it was different than a lot of tech companies, which sell mostly to businesses selling software or equipment. This was a company that was tied to the consumer, and they sold a product that was positioned at the very high end of the market because they had a new product and so they were sort of entering the market with a premium price product. So people were worried about the consumer in what was looking like a deep recession. They were worried about anybody that would pay a premium, and so this is the company that I was looking at, and suffice it to say that things worked out okay. Remember, this is the iPhone came out in 2007, so it hadn't been out for very long. There was no app store yet. So much of what drove Apple's success was yet to take fold. So here's the chart. I'm buying Apple kind of in this early 2009 timeframe around $3. So it didn't go up right away, but it by the end of the year it had doubled, and 4 years later it was up sevenfold. So in the end, it seems like I should be thinking about this as like, are you familiar with that Capital One ad campaign where they talk about a decision that's the easiest decision in the history of decisions, where they're showing examples like Charles Barkley on the playground being picked by little kids in their pickup game, and then they decide that Charles Barkley is the good pick. I mean, it seems like in hindsight, it was that easy. And perhaps it was, but at the time it seemed risky. And what everyone worried about the economy and the stability of the financial markets that was still happening there. So, what's the real world lesson here? And it's that markets do go to extremes. And Selectron at $45, Apple at $3 were excessive in both directions. And that's obvious in hindsight. But how do you know in the moment what's happening? And what I'm trying to say is that the price, the $45, the $3, that really doesn't tell you, given we know what can happen. It's valuation that matters, and price alone will not tell you. And I'm going to get into later the difference between those two things and whether there is a difference. But that's what I'm starting to introduce. And this is my first Warren Buffett quote that I want to share with you, which is, what he's saying here is that if you're sitting at a poker table and you don't know who the patsy is in the room after about half an hour, chances are that it's you. And what he's really saying is you have to understand the game that you're playing, and you have to understand the value of your hand. And valuation is how you understand those things. And so, that's obviously true in my life as an investor. But that's enough about my background. You've heard enough there. But let's consider if it's true elsewhere in places where you're dealing with valuation. And I would argue it's not just if you're investing, if you're thinking about valuation as a public investor. It's true as a private equity investor. It's true if you're serving a client as an investment banker. It's true if you're listening to those investment bankers and you're the CEO or CFO of a firm and you're thinking about making an acquisition. Or if you're selling your company and you're taking that advice from an investment banker, if you don't have a firm grasp of valuation, then you can't hope to be successful. And that's much easier said than done is what I would say. And the reason why that's true takes us to the second half of what we're talking about, which is not just booms and busts, but the point that I just made, which is that stock prices and valuation. Now, maybe when you quickly read the title of this talk and decided whether to sign up, you might have thought that those were two ways of saying the same thing. And so, one of the most important points that I, want to not only get across, but I want to convince you of is that's not the case, that price and value are importantly different. And another sort of nuanced point is that much of what Wall Street calls valuation is really pricing. And so we need to understand the difference between them. Now, I'm saying they're different, but theoretically, that's a debatable statement. So to see why some folks might question whether there really should be a difference between price and value, we need to consider something known as the efficient market hypothesis. Which is, one of the fundamental precepts of modern finance theory. And so, I want to ask you to ask yourself as I start to talk about this, as you enter into sort of thinking about it, do you believe in efficient markets? Is that something do you think that markets are efficient? And in case you need a reminder, or perhaps you're learning for the first time, here's what we're talking about when we talk about the efficient market hypothesis. So the idea is that stock prices reflect all of the information that there is to know about a company, and that any new information that is introduced into the world is immediately discounted by the market and is immediately reflected in that company's stock price. And a key implication of this idea is that stock prices are therefore correct. Because the foundation of valuation, as we'll talk about, I'm not going to be the first time I'm going to say that a company's value is the present value of its future cash flows. So if a stock price always reflects everything that there is to know about future cash flows, and that's what defines a company's value, and any new information is immediately discounted by the stock, then the price is right. And since we can't know what's going to happen next, stocks are going to go on what's known a random walk, because they'll go up or down depending upon an unknown future development. And most importantly, again, price and value are equal. There's no such thing as a mispriced security or an overvalued or undervalued stock. So the minds behind the efficient market hypothesis have won Nobel Prizes for these ideas. So certainly when I was coming out of school, and I happened to get my MBA at the University of Chicago, which is where most of the guys who formulated these theories came from, I certainly found it hard to think that that theory was wrong. But what do we make of, let's go back to the Selectron chart. What do we make of this in light of what I just talked about for the last couple minutes? This shows the boom bust phenomenon that I lived through in the early 2000s again. And I think it makes a strong case that prices are not always right. It might be hard to read this chart precisely because of the scale, but in April of 2000, the stock was $46. And by the summer of 2002, so a little more than 2 years later, it was $4. That's a 90% drop. And I think it's fair to say that the market had to be wrong in one of those times, and I would actually argue was wrong at both. And importantly, I'm not saying that it's easy to consistently identify those mispriced assets and to accurately time when to buy them or to sell them. The fact that most professional investors underperform the market most of the time supports that view. And that's why things like index funds came out of the efficient market hypothesis. But this chart hopefully helps to convince you that the market does often misvalue assets. And so let's talk about why that's true. And so the idea here is that one of the ideas of efficient markets and of modern finance theory is that capital markets are supposed to be rational. That's an underlying principle in modern finance theory and in efficient markets. But people are not always rational. That manifests in many ways. We're biased, for example. There are many biases. We have biases regarding, for example, things that we're familiar with. And one of the things that I was going to say, I'd like to say it, but I don't like to say it because the example I'm about to give you is not the greatest. But I've often said that I made the least amount of money in my buy-side career on the companies that I know the best. Theoretically, the better you know a company, that also that gives you insight, and that my knowledge should be helpful. But it also, at what point is it's created bias. I know the management and the business very well because I covered them very closely in my prior life, and my objectivity, therefore, is lost. And I kind of anticipate I'm living in the past too much, and so I can be swayed by things that are happening before that may not hold true in the future. And so, two stocks I can think of, both locally based in the Chicago area: Zebra Technologies. They make barcode printers, was their core business, and Littelfuse, as their name suggested, they make fuses, and they're not all little, but they make electronic components. Both of those stocks are up 10 times in the time that I've been on the buy side at RailSplinter, and I have owned neither one of them. And so there's lots of biases that keep us from making rational decisions. We believe that things we own are worth more than identical things that we don't own. That's why there's $100 billion storage industry, self-storage industry, for us to give us a place to put all the stuff that we're all overvaluing in our lives. People don't treat all sources of income the same. You're more likely to spend, if you have an unexpected inheritance or a surprise bonus, you're more likely to spend that than you will if you get a salary raise. And that's the reason why 70% of lottery winners don't use their money wisely, and many of them end up going bankrupt. That's a bias in terms of how you think about the money that you received. So there's lots of them, and there's also noise that's very important in our decision making. That's why you can ask multiple experts to assess the same situation and you get lots of different answers. There's a study that shows an insurance company that gave a group of underwriters the same information and asked them to price a policy, and got results that had a 55% range amongst supposed experts all looking at the same thing. A doctor, for example, might give you a different diagnosis in the morning than if they saw the same situation in the afternoon, which is kind of a scary thought, but it's been proven to be true. And now, how you deal with these things is you just have to be aware of them and try to adjust for them. That's why when I grade exams, for example, I don't grade one student's exam from start to finish and go to the next one. I grade question 1 for everybody. Then I go on to question 2, et cetera, so that I'm not biased differently for the student that I graded their exam in the morning versus at the end of the day when I'm tired and have graded exams for hours and hours and I'm finishing up. So we have to recognize that there's a lot of different psychological elements that affect what we're doing. And one that I want to hone in on a little bit, kind of gets back to the booms and busts, is this idea of prospect theory, which leads to loss aversion. So the idea is that people feel the pain of losses more than they enjoy the pleasure of achieving a gain. And that makes us risk averse. So, for example, if I have a coin and I'm going to flip that coin and I tell you that if it comes up tails, you owe me $10, how much would you have to gain if it comes up heads in order to be willing to take the bet? If you were rational and I told you I'd give you $11 if it came up heads, you should be in. That's objectively, rationally a good bet for you. But the truth is that it's been shown that you need $20 in order to be willing to make that bet. So that's a powerful bias, and it's why it's hard to get people to invest in an opportunity when risk is low, because risk being low means valuation is low, which means that lose, because usually when valuation has come down, it's oh, let me know if anybody can't hear me. I'm getting a signal, so just let me know if I end up breaking up. But the point of people are placing more emphasis on on the risk, and so I'm living that right now at my firm. We launched a new fund about 1.5 years ago that invests exclusively in very small companies whose market capitalizations are $1 billion or under. And I could show you a chart that details how the valuation on these names is at historical lows, particularly relative to the rest of the market. And that means risk is low because there's less downside than there is upside. But they have not done well. That's how we got to this situation. And people are concerned about investing at this point in that cycle. And so they're more likely to invest after there's a rebound and things have gone up by 40 or 50%. They'll be more interested in what we're doing at that point. And so, and that's kind of true in terms of when you think about bubbles. That's why that happens, that people, even though risk is high, if everybody else around you has been making money in an investment, and remember, it's based upon something that's true. You're investing in the internet, you're investing in generative AI, and we know that's going to be a big deal. And they're more likely to follow the herd. And so that kind of gets back to the psychology of that creates the booms and the busts. And so, this is a quote that suggests that, that in a supposedly rational environment, where professionals are trying to make money, it's the only place I can think of where people are more interested in something that's priced high than they are in something that's priced low. And this quote is from a famous investor, but maybe this is a better way for me to express it in terms of how the world operates and how people think. So, and that's why bubbles happen again and again. Sometimes they aren't that dramatic. We saw kind of a bubble, I think, kind of coming out of the pandemic. I'm arguing that perhaps we're seeing some excessive valuations in 2023 with what's now known as the Magnificent Seven stocks, many of which are considered to be direct beneficiaries of ChatGPT and generative AI. NVIDIA, who makes the processors, and Microsoft, who's got a large position in the company that introduced ChatGPT, Google, et cetera. And so, that is demonstrative of what can be happening in the market. So, for the final segment of the talk today, I want to talk about the difference between price and value for a bit. So, here's another Warren Buffett quote. There are lots of Warren Buffett quotes, but this one, frankly, is probably my favorite because it's the most insightful for me, because it really helps to help you kind of understand the difference between price and value. So, importantly, most people, what they talk about as valuation, like I said earlier, is actually pricing. And I want to talk about what the difference is, like I highlighted earlier. So here's my favorite chart that summarizes the price value relationship. And if you ever take my valuation class, you're going to see this chart a lot. And on the left is value. So as I've mentioned once already, the value of a business is the present value of its future cash flow. And so it's determined by the things that we're detailing on the left. It's the current cash flows, it's the growth in that cash flow, and the risk, which is a factor that's as we value it, we need to do a present value of the future cash flows. So risk will affect the discount rate that we use to arrive at that value. And so what we're doing here is we're using this analysis to estimate what that value will be. And an important word that I want to stop and emphasize is that our view of value is an estimate. And so I want to point out that why am I saying estimate as opposed to calculating or determining value? Because value is based upon, as I've said a couple of times, but hone in and reemphasize, future cash flows. And we don't know the future. And so we'll come back to that, but that's one side of it. The other side is price, which is simply what someone is willing to pay. And as we talked about earlier, in an efficient market, there's no difference between those numbers. Everybody knows everything, and the resulting price is the same as the value calculation I just described, because everyone acts rationally and as they process that information. So hopefully, after everything I've been saying, you're not so convinced that's the case, and instead, hopefully see that often it is not. So this chart that shows you on the right several things that can drive price, and what's important about them is none of them have anything to do with cash flow. And so that's the emotional element of things, and the reason that price can differ from value is kind of illustrated here. The other point that's important and why I like this chart is it shows you when they're different, there's a gap. And that's what we're looking for in investing. We're looking for a gap, and then we're looking for a gap that we understand and can exploit. And so the question becomes whether that gap is going to close, and equally importantly, when it's going to close. And so we need to do two things. We need to go through the process to estimate value in our view so that we can gain conviction about what we believe is valuation. And that conviction gives us the courage to act on what we think is the difference between value and price. And then we need to understand a little bit about making sure that our timing is good, because like I said, earlier, it gets back to the example of the Selectron downgrade. We not only have to have the right answer, but we have to have it at the right time. Otherwise, we could be wrong simply by being too early. And the other reason that it's not easy to do this is because there are so many assumptions that you make when estimating valuation. And so that means that that brings us back to the power of the idea in the marketplace of the efficient market, right? I mean, our finance training, as I talked about when I introduced the idea, has taught us that valuation, it shouldn't be different than the market's price. And for us to know that it's different is impossible to do because we don't know the future. And so maybe if by nature you're a contrarian, you're more inclined to think that way, but I'm not. And so it's difficult. When I see a difference, I think that it's likely that the market knows something that I don't. I mean, I'm searching for what is making the price different than what I think it should be based upon what maybe I don't know about. And so it's really important, therefore, to have conviction in your view of value, and that's a process we go through. And I'll talk about that a little bit more in a moment. But it's also why investors like to talk about catalysts. They like to talk about knowing the reason, a new product that they think is going to be introduced that the market is not fully aware of how important it's going to be, or some kind of an announcement that they're anticipating that perhaps the market hasn't really got understood better to sort of be the reason that the valuation and the price will converge in their favor. All right, so let's talk a little bit about, as I've just covered, the importance of your method that you use to determine intrinsic value, to give you that conviction. So the words intrinsic value, mean that it gives you the feeling that it is knowable, that we can determine what it is. But I think I've discussed the fact that That's not the case because of the uncertainty surrounding the factors that drive it. The growth in the cash flow, the risk that's associated with it are things that we can't know for sure. So that inherently drives some uncertainty in the intrinsic value that we are trying to arrive at. But that doesn't change the fact that making our estimate of intrinsic value is a very important exercise, because it does help us to understand what are the things that we know and what are the things that we want to learn more about as we do more research and as we explore more about what we think is happening with the company. And it also helps us to understand what's driving value. Well, what are the, is it a company's, just is it its growth? Is that growth coming from a market that's growing? Is it coming from a company's ability to gain market share? Is it coming from a new product? Is it coming from margin expansion because the things that the company's doing to reduce its costs or to gain greater pricing power? So we by doing the work on really on modeling out what we think is happening in the future, we may not know whether we're right or not, but we're going to understand a lot better what creates value and what we believe value is. And so if that work gives us an answer that varies from the price, and it gives us confidence because we've gone through the detail and conviction in our answer, that's what makes our estimate valuable, because it's likely that it gives us the confidence to take action. And if we don't do anything, even if we're right, what difference does it make? So that's why the act of kind of doing the valuation is important. Now, how do we do that? We estimate intrinsic value with a discounted cash flow model. And the details of how we do a discounted cash flow, that's beyond the scope of what I have time to talk to today. It's actually the heart of my class, is learning how to build with and work with these models. But it comes back to the basic idea that intrinsic value is the present value of future cash flows. So that means we basically have two jobs. First, we have to project the future cash flows from our business over the life of the asset. And the second thing is we need to decide on the interest rate that reflects how uncertain those cash flows are. We project the cash flows out into the future, and we calculate their present value with the interest rate that we've decided is appropriate. And so what I've just described to you is a discounted cash flow model. And a DCF is, like I said, it's very detailed. So one of the things that we'll talk about is it's not necessarily the most practical way to do valuation. It's not the easiest way to do value, but it is the essential foundation. So you do need to understand how it works, and in your mind, sort of, understand those value drivers. So even if in the end, as I'll talk about later, I know I don't have the ability to build a detailed DCF all the time, I have a thorough understanding of how it works. And in my mind, those principles are important, and that's what's critical. And the reasons for that are it's a thorough analysis. And what that means is you're valuing the business so that you can turn around and consider the stock, which is I'll talk about, is better reflected by the price. And so the discounted cash flow helps us arrive at value. The stock has a price, which we'll talk about in a couple minutes, and and they often are different. And then that gives us a chance to do something about it. So the importance is to understand the details of your analysis. And if we look at it, like take a complicated company, a big company like Amazon. And you may have a view on Amazon based upon what you think is happening in the e-commerce market, maybe you think that Amazon's peaked because e-commerce got so popular during the pandemic that it's not going to grow like it used to. And so you're concerned about whether or not it makes sense to own Amazon as a result of that. But now you may be right, but just that intuition hasn't really caused you to thoroughly analyze the company. There are a lot of other things that are important with Amazon. They have a huge cloud computing business, which is much more profitable than their e-commerce business. And so you need to understand that business, and you need to dig into that. They have invested during the pandemic a huge amount in infrastructure, distribution centers, and a fleet of delivery capability that now that they're post-pandemic, they can grow into that, and their margins are going to improve. And so I quickly run through all that just to sort of give you a feel for the idea that that's the kind of stuff that you are modeling out that's much more in-depth than just looking at the price of the business. And so that's the value in doing the discounted cash flow and really understanding the details of the business. So let's talk a little bit though about why there's many who are somewhat negative on the idea of using a discounted cash flow. First of all, it's the accuracy of those projections that I talked about. Like I've touched upon just now, they involve so many different assumptions. So you need to make assumptions about all those different variables in order to complete the analysis. And is it practical that you have the time to do it, that you have the resources to have a reasonable view on all of that? And how about the reality of how difficult that is to do relative to other methods? And so what I mean by that is it's difficult to communicate a DCF. We're going to talk in a minute about just the price of the stock and how that's determined and what that really says. And if you have just a few minutes to talk to a client or talk to your boss about what your recommendation is, walking them through all the details of your DCF is sometimes just too much for you to be able to accurately communicate. So that makes it a difficult thing to do. And then the other side of that is that people are often skeptical of a DCF because of all the complexity and all the assumptions that drive it, is that can make them relatively easy to distort, and for people to use it and to to sort of make the valuation say what they want it to. And that gets back to to biases. It's easily to manipulate the outcome. So if I'm in my old job as a sell side analyst and I have a recommendation on a stock, well then I can probably twist the assumptions to make the stock look attractive. And if I'm an M&A investment banker trying to help a company that's trying to buy another company, I can help that company with assumptions that'll make the target company sound inexpensive. And so my biases can lead to changes in assumptions that can lead to a wide range of outcomes with a DCF. But that said, I've hopefully have kind of explained why it's still very important to be able to kind of have that anchor of your view on valuation. But let's talk a little bit about pricing and how that's different than value and how does it work. So to kind of start that discussion, here's a question I want to ask you. Say I tell you that Walmart stock is priced at $160 per share. Target stock is $112 per share. If I ask you which company stock is more expensive, would you say Walmart? Would you say Target? Or would you choose C? Based on what I've told you so far, you have no idea. And based upon the way I framed the question, you very well likely are going to say C. But ask yourself, was that something that you kind of understood, that the stock price itself doesn't tell you anything? And here, let's talk a little bit about what are some of the things that we might know about Target and Walmart. So we know it's not the stock price, because all the stock price is the market capitalization of the company divided by the number of shares outstanding. It's a kind of random number. But what if I told you that the market cap, like we show you here, is $430 billion for Walmart and $51 billion for Target? Does that tell me that Walmart is more expensive than Target? Well, not necessarily, because what if I told you that Walmart has 10,500 stores and Target only has 2,000 stores? So to say that based upon the market capitalization that Walmart is more expensive is like saying that a case of beer is more expensive than a six-pack of beer. And in the world of beer, we know the opposite is true. You buy more bottles of beer, you're going to pay less per ounce, and you'll pay less if you buy them at a grocery store than in a convenience store, et cetera. So that isn't really telling us anything. But we need to come up with a way to sort of to measure it that's more like that price per ounce example that I gave you. So what if I told you that we had a price earnings multiple, which is I show in the right column there, and the Target's ratio of its share price, the $112, to the next 12 months earnings per share, the net income that they have divided by their shares, that's a PE ratio. There's a 13 times ratio of this company's stock to the earnings that it has. And Walmart's, using that same equation, is 23 times. Now we're getting somewhere. That multiple, that ratio between the per share stock price and how much earnings there are per share, that's something you can use to compare similar companies. So that ratio is used and that does tell us that Walmart is more expensive. We're paying more for $1 of earnings for Walmart than we are for Target. So it is a more expensive stock, Walmart versus Target. Now, what if I told you that Lululemon sells for 27 times earnings as opposed to the 23 or 13 times? Does that make, now the question I'd ask you is, does it make sense to compare Lululemon to Target and to Walmart? Well, they're both retailers. When we think about what's going to affect their business in the near and the long term, it's the health of the consumer. So in a lot of ways, they are comparable. But Lululemon has its own brand that dominates its sales. That's a small part, if at all, about what Walmart and Target are doing. They're selling to a higher end consumer. There's differences that I think we all understand about Lululemon versus Walmart and Target. The financials might be different. Lululemon might be growing faster. They might be more profitable. They go on in a lot of ways that they're different. But even though they're not exactly the same, if we're trying to get a feel for how expensive all of these companies are, it's not a bad comparison. It's somewhat instructive relative to if I told you that Microsoft is trading for 29 times earnings. Well, it's pretty obvious that almost tells us nothing about Target or Walmart or Lululemon. They have nothing to do with each other. So there's a continuum, and you need to try to understand, what's the right way to kind of understand the price of the stock. But so let's talk a little bit more generally about relative valuation. So what we need to do in order to conduct a relative valuation is we are pricing in all those cases, and we need to identify comparable assets, because we don't want to compare the price of if we go into a Starbucks, we don't want to compare the price of a donut to a cup of coffee. They're not the same thing. But we might want to compare the price of a cup of coffee at Starbucks to a cup of coffee of Dunkin' Donuts to help us understand which one's expensive and which one is not. So, but we're using a standardized metric, which is what I walked you through with the PE ratio in order to do that. But multiples are just a price. And it's just like that a $20,000 car is cheap and an $80,000 or inexpensive, I should say, and an $80,000 car is expensive. 10 times earnings for a company is inexpensive, and 50 times earnings is expensive. Now, there may be reasons, as I was describing Lululemon versus Target, let's say, you might believe it's worth paying twice the price for Lululemon than it is for Target. What we're really looking for is comparability. That's the important, but we're also looking to try to understand that all that it is a price. Nothing I've described has anything to do with the fundamental equation that I explained to you, which is that the value of business is the present value of its future cash flows. So there's a lot embedded in that number, but it all boils down to that it's a rough answer that's easy to consume, and that's why it is so popular, is because it is a relatively straightforward way. If I compare it to sort of what I was describing earlier, which is the complexity of trying to describe the nuances of my discounted cash flow, much easier to get that point across by just explaining what the price is and talking to a knowledgeable audience about whether or not that price is inexpensive and trying to argue as to why that it is. But some of the disadvantages might be that, what if a whole group has gotten to be very expensive? And so we talk about the peak of the internet bubble, or let's talk about what was going on just a year and a half ago when every software company was trading at a very expensive price, just objectively speaking, and certainly relative to anything that has been priced at in the past. And so if I come along and I tell you that the average software company using a certain multiple is trading at 30 times and Salesforce.com is trading at 24 times. Well, does that mean that Salesforce.com is attractively priced? No. If they're all going to go down 50%, all it means is that maybe in that environment, Salesforce.com only goes down 30%. And so the price alone does not really give you the comfort that you would hope in terms of buying something that's inexpensive. But on the other hand, some people and most professional investors always need to be invested. So even if everything is expensive, they're looking for the least bad option, and they live in a relative world. And in that sense, pricing works well. The same thing's true for an investment banker. If they're being asked to go in to talk to a prospective client about what they think the price is going to be in the marketplace for a company that wants to have an IPO, maybe they think that price that could be achieved in the marketplace today is expensive. But they're not going to win the business by explaining that they think the company's overvalued. They're going to win the business by saying, we're the guys to go out there and get you the best price possible. So pricing can often be the thing, and that's in a lot of ways why it is the most commonly used approach in the real world, even though, as I've hopefully explained, it's not ultimately the answer in terms of what's the real value of something. So I want to wrap up. I've been talking for close to an hour, and I don't want to go on any longer, but just kind of quickly explaining how do I reconcile these things. And there's a concept called expectations investing. I came across it a long time ago. There's a book called Expectations Investing. I think the authors' names are Michael Mabusson and Alfred Rappaport. It's a great idea. It's not the greatest book, but so let's just talk about the idea. And that is the idea that, like I've just been saying, I will not make an investment decision based solely on the fact that a stock has an attractive price relative to anybody else in the marketplace. I want to know the price. I want to consider the price. It's a place for me to have an initial sense of whether something's expensive. But if it's just a multiple, that doesn't really give me the answer that's satisfactory to me. But I'm acknowledging that building and maintaining a detailed discounted cash flow model for every holding is not practical. I don't do it. I can't do it. I don't have, even if I had 3 people working for me, I don't think that we would have the resources to do that. So what's the right way to sort of use DCF concepts and do valuation without just relying upon price? And what I do is I try, and this is the idea of expectations investing. I try to infer the idea that there's a set of DCS. Every stock has a price in the marketplace every day. And there are a set of DCF assumptions that are embedded in that company's price. And what I would tell you is those assumptions are basically the market's expectations at that time. And so what I'm trying to do is I'm trying to use the stock price to infer what those expectations are and then compare my expectations to what I believe the market believes. And so that can help me understand whether or not I think the market's expectations are conservative and will be easily exceeded, or whether or not I think they're aggressive and that they're more, and the company's more likely to disappoint. And that is, and if I have a set of assumptions about the future that I believe are greater than what is inferred into the stock price, then that's something that is appealing to me, and that allows me to think about things in that context. And the objective, as I say here, is to anticipate how and when the market's expectations are going to change, such that if I'm in front of that I can succeed. So I think with that I'm right at about an hour, and I don't want to go on any longer than that. And I think I've pretty much covered everything I've got. So thank you for those that have been listening. I appreciate it.